Quantitative easing is injecting new money in the economy. The Fed does this by printing money and lowering the interest rate. This helps the economy grow. Does this make sense to you?
Yes.
Okay, so what is quantitative easing? I wish it was that simple. By the way, that was mini-me. He really wanted to be in the video, so over the weekend, the Fed changed the Fed fund rate, now targeted at 0 to 0.25%. In addition, the Fed launched a $7 billion quantitative easing program. What does this mean and why should we care? What's happening, everyone? Welcome to Think Finance. My name is Raj, and on this channel, I talk about personal finance, investment ideas, money management tips, and all things finance. If you're new to the channel and finance is your thing, consider subscribing. Recently, the Fed has taken all sorts of measures to counter the economic slowdown driven by the pandemic. They started by injecting $1.5 trillion through repurchase agreement or repo operations. Then over the weekend, they changed the Fed fund rate to 0 and launched $7 billion quantitative easing program. And finally, earlier today, Fed announced another $500 billion through repo operations. In this video, I want to talk about what is quantitative easing or QE, why is it needed, how does it work, and what does QE and zero interest rate mean for us? Okay, here's the short version. The Fed injects cheap money into the economy to encourage lending, borrowing, and spending. The goal is to stimulate the economy and avoid a slowdown. That's it, video done. Now the longer version. I won't share any official definitions. I think the internet does a better job with that. I just want to try and simplify the concept and discuss what this means for us. Let's start with some basics. There are specific reasons why the central bank or the Fed exist. Regulate banks, provide financial services and research, and finally execute monetary policy. The goal is to manage the currency, economic growth, unemployment, and inflation. Central bank uses expansionary monetary policy to stimulate the economy, lower unemployment, and avoid a recession. Contractionary monetary policy is deployed to counter inflation. QE is a type of expansionary monetary policy designed to lower interest rates, increase money supply or liquidity, and spur economic growth. The Fed manages liquidity by printing money. Well, not exactly printing, but issues a credit to banks. It is Fed's solution to spur lending, borrowing, investing, and economic growth. The hope is this will avoid a recession or get us out of a recession if we are in one. I think we are in a recession, but that's just me. So how does this work? The Fed has two tools it relies upon: Fed fund rate and open market operations. When you hear that the Fed lowered the interest rate, they're talking about the Fed fund rate. Over the weekend, the Fed announced that the Fed fund rate is now targeted at 0 to 0.25%. See, when the Fed wants to print money, it lowers the target for the Fed fund rate. Fed funds are what banks are required to hold in reserve each night. A bank will borrow Fed funds from another bank to meet the reserve requirements. The interest rate it pays to other bank is called the Fed fund rate, which just got lowered. Now they eased the reserve requirements as well over the weekend, meaning there is flexibility in banks' reserve requirement, and that means more money available to lend. A bank would like to lend every dollar it doesn't have to hold in reserves. The Federal Open Market Committee, or FOMC, is Fed's operations arm. When FOMC lowers the target for the Fed fund rate, It allows banks to pay less for borrowed Fed funds. Since they are paying less in interest, they have more money to lend and at a reduced interest rate. That makes capital or money more affordable, so businesses are more likely to borrow and invest in business. All of this drives economic growth. The Fed's other tool is the open market operations. This is where the quantitative easing comes into play. Under QE, the central bank will buy mortgage-backed securities and treasuries from its member banks, which again increases liquidity in the form of money in capital markets. Again, more money to lend. What does this mean to us? The greater the supply of money in an economy, the lower the corresponding interest rates. Lower rates allow banks to make more loans to you and I. Cheap money drives demand from businesses and individuals. Businesses use money to make business investments. Your cost to borrow will lower. If you are planning to buy a house or a car or refinance your mortgage, all of this will get cheaper. Basically, this will encourage lending and borrowing, increase employment opportunities, and increase consumer spending, and hopefully avoid a recession. Money out of thin air. Okay, that's all I have, guys. If this video was helpful, hit that like button, and if money is your thing, consider subscribing. Until next time, peace.
What if